Good morning, everybody. Welcome to 10 Figure Business Mastery live webinar Wednesdays. Good to be with you. Hopefully, you can hear me. This is great. Damn. Jamming it out before the calls. Let's go. We're going to get started in a few seconds, guys. Glad to be with you today. All right, good morning. Happy Wednesday to you. Once again, welcome, 10-Figure Business Mastery. Let's go. Let's get into this, guys. All right. So this is me, Cheston Bulgin with By the Books Consulting, senior consultant and founder over here. You can reach us by these means, bythebooksconsultants.com or at youraccountingsuperhero.com or at theaccountingsuperhero.com. Any of those domains will bring you to us. And you can reach me directly via email. That's my email address. Don't abuse it. All right. And we do things financial with the compliance and advisory work in terms of bookkeeping, tax services, tax advisory. We look at making sure you're able to keep more of your hard-earned money through tax strategy. We keep you accountable in certain areas when you work with us. And we're doing this process here, this what you see out here on this slide. We do this on a monthly subscription level so that you don't have to have an exorbitant cost at one time in the year. You're going to pay a whole lot of money. So we do all this and we make sure that you're set up to win inside of business. That's what we do. We just finished a boot camp. Inside of that, we just did a QuickBooks Online boot camp this past Sunday. Good event, guys. If you weren't there, you missed out. Okay. If you were there, make sure you take advantage of the things that we learned inside of that boot camp. Get organized, crush your QuickBooks, crush your business. Make sure you're able to level up inside of what you do. And we're continuing to talk inside of tax season and tax preparedness today. I know you guys love to talk about tax stuff. Let's go. Come on, man. Get tax information for you. Make sure you are set up for wins in this area specifically of your business. Some things that we're going to talk about today, you may not have been thinking about. I like thinking about these things because the more that I can gain in terms of insight, understanding, and then take action toward that insight and understanding, of the higher probability or the more guaranteed my success will be. If that makes sense. Okay. So this conversation will serve to make sure that you're set up that way when it comes to being ready every single year come tax time. Now, it's going to be a pretty straightforward call today, getting into some technical stuff, but I want you to understand the impact of the choices that you make, regardless of whether you understand what you're doing or not. Okay. But now you're going to have some insight, some understanding on some of these actions that we're taking throughout the year, cash flow wise, financial wise, that impact us throughout tax season. All right. That being said, quick disclaimer before we get started. The following is for educational purposes only and is not to be considered financial accounting or legal advice. Please consult your tax, accounting, and or legal professional for specific advice. And the tenets on which we stand inside of this group, number one is mindset mastery, which is intentionality. Number two is financial mastery, well, also known as financial literacy. Three, structures and system mastery. And then last but not least is actions or execution mastery. Guys, any of these things, if they're out, then we don't have success in business. For those of you who are with me for the first time around, mindset mastery and intentionality means that I am focused. I am focused on what it is that I'm here to do. What am I here for? A lot of times we can get distracted by life, distracted by ourselves. What are those distractions? What do they look like? Well, it could be, man, I don't know if this is going to work for me. That's a distraction. That doesn't serve your purpose in life, to think that way. Do not entertain those thoughts. They may come. You don't have to indulge in them, right? Or something's wrong here with like what I'm doing. Now we're not focused on the thing that we're here for, which is crushing in my business. Do you understand, like, you even feel the power level and the shift when I get the focus on crushing it in my business? I'm not thinking about whether or not I'm going to succeed or fail. When I get mindset mastery, it's inevitable because I'm here to do the job. There's no other option. I'm focused on it. All right. So it's very important that we get this, guys. All right. This is like first and foremost for a reason, is because everything begins here and really comes back to this every single day, every single moment. I get a choice on where I'm going to place my attention. And this is what we call mindset mastery. Okay. Now, financial mastery, of course, this is a conversation that we're in a lot. financial literacy, understanding the numbers and the story that the numbers tell. Okay. Now you want to get really good at doing that consistently, reliably, so that you have a business that works. Structures and systems, leverage, guys. So leverage is something that will take our businesses to beyond what we even thought possible. Some of us are solopreneurs. Somebody listening in likes to do things themselves all the time. It's fantastic. It's great because you're empowered through doing things on your own. At the same time, you may recognize that limitation. You may not want to be on your own. You may feel as like you're the only one who can do the things. You can't rely on anybody. You can't trust people. Or you just don't know how to build those systems. Well, people are doing it. Businesses are doing that. And you have the opportunity to do that. I remember when I was getting started in business, and even today, I had that thought process is, man, I'm the only one who can do this right. And somebody else will get it. They're going to mess it up. This is my baby. And I had to give up that thought process in order to grow beyond it and have systems in place where I have other people that can come in and do the job and leverage human capital, leverage technology to be able to grow beyond whatever I could do just on my own. And it is a lifestyle, it is another approach, is a paradigm shift per se, like the way that we think about things wants to shift so that we're always looking to develop systems so that we can do more with less. Now, I could probably do a lot more single-handedly than a lot of folks because of the leverage that I have in terms of systems and structures. But I wouldn't be able to do that if I wasn't even inside the conversation of structures and systems. Okay, it's that important. Last but not least is actions. And nothing makes a difference. None of these other things will matter unless we execute. Got to go out there and take the actions that matter, the actions that count, the actions that align with what we're here for. Okay, we do all these things, guys, we win. Bottom line. All right, so today's talk, we're talking about loans, more so about loans and how they impact taxes. Okay, this conversation, man. Why am I talking about this? Because business funding is sexy. Like getting loans, it's sexy, right, for your business. People want to position themselves to get a business loan, lines of credit, some type of funding and financing so that they can have more cash in their business. And they feel there's a feeling around that, right? It could be a feeling of safety. Like I have a better cash position. Now I have some room to breathe inside my business, or I can finally move out to, purchase some more business assets in the business, which is fantastic. Or I don't know, man. It's just like, well, what is the purpose of that loan? This is what we want to get down to. Whenever we consider getting capital, when we talk about capital, in this case, we're talking about loans, like liabilities. Whenever we're looking at getting loans in our business, we want to understand specifically what that purpose is that loan is going to serve. If we don't, then it's quite possible that we're setting ourselves up to have a catastrophe, something that's just not going to work down the line. I remember hearing somebody come to me because they really wanted to get more financing, and they already had financing. They had a lot of it. They were actually paying off these loans, and they wanted to get more loans in order to help out with the cash flow of the loans they were paying off. And I could feel it. I could feel that never-ending swirl because of choices that were made. It's a spiral downward. It doesn't have a long-term opportunity for long-term success. It's just going to be something that eventually, if something doesn't shift drastically, it will cause the business to fail. It will cause the business to suffer. We want to get this. Loans in and of themselves are not bad things. They're great, actually. And we also want to get that the people who sell loans are not really interested in whether or not you're going to do well. They're interested in making sure that you get the loan because they don't get paid otherwise, for the most part. You're going to come across these people and they just want to sell you financing without considering how much it's going to benefit you when you take on that financing. So you want to understand for yourself, what are the benefits? of me taking out these loans? What are the implications of it? What's the impact? Now, how am I actually going to win on the other side of this? Today, we're talking about the impact on taxes so that we can see a little bit more so, like a broad systemic view of loans in general, because this is just one side of it. But through this conversation, hopefully you can see like how it really stems across all other areas of business, not just taxes, but in other areas too. Okay. All right. So basis. We're going to start with the basics, which is basis. This is a terminology here that a lot of us don't think about, but I do. You know, I think about this. It's in my head a lot. But you want to start thinking about this if you haven't understood basis, or if you haven't really heard this term basis, you don't really approach it. And now, guys, as a business owner, you want to have like a real good, like broad understanding of the components of business in general. Like you just want to know business, period. Yeah, you want to know how to provide the service that you provide. And you also want to know how to manage people. You want to have those skill sets to lead people, to manage people. You want to have those skill sets to communicate. You also want to have those skill sets to do the technical components of what it is that you do inside of the service or inside of the product that you deliver. You want to have a real good understanding of that. Team building skills that you want to have. Yes. All right. You also want to have basic financial skills, like the financial skills that you want to have. You want to have like the ability to, count, dollar for dollar. Did I make money today or did I not? Basic math skills. You also want to have some financial skills, real good financial skills. Okay. Understanding how finances work in your business. Well, things like cash flow, things like profit and loss statements, income statements. And, you want to have a good idea what a balance sheet is. Okay. And then you want to have things like this in your mind too, like things like basis. What does that mean? And what am I doing throughout the day that impacts this thing? Okay. So what is basis? Basis by definition inside of the IRS, it is the amount invested into property, or in this case, even businesses, for tax purposes. Okay, so if you think about it like this, and I'm going to give you the full definition here from the IRS. IRS has all these components of basis. Okay. So basis is generally the amount of capital investment in property for tax purposes. Basically, that means that whatever is inside of the cost of it, the investment in it, what you put into it in order to acquire this thing. Typically we think of this in terms of real estate. Like we go out there and we buy a property, like we buy like a single family residence, and there's a certain amount of money that it costs to get it. That purchase price plus the closing costs, that's the basis of that asset when it's bought. All right, that's how much that's in it. That's the cost of it. That's the basis. Okay, so things that impact that. All right. Over time, like for example, in this same thing, the same real estate example, there is depreciation. So depreciation takes away from the actual basis that you have in it. So what is depreciation? Is the expense of the asset value over time. So if I buy $100,000 piece of equipment and it's depreciating over 5 years and it's going to have no value at the end of it, that's what I'm considering. It's going to have no value, right? So over the next 5 years for this piece of equipment, it's going to take away $20,000 each year out of that basis in terms of depreciation. Okay. So that's something that impacts it. Okay. But what about what we're talking about here in terms of your business? Now, your business is another type of asset. So it's comprised of, well, how much money or how much income or how much revenue is made by that business to improve or increase the value. What was put into it by you in the beginning? And then after the business starts to perform, how much is left in it? All right. So the things that would impact that basis over time inside of your business, All right, if you're in your business, let's talk about this for a minute. Business, this is business, okay? The things that impact it over time are net income, or loss, owner investments, we call it capital contribution. Capital, like you put capital into your business, like you want to put money into it. Gotta love my writing here on the keyboard. Owner contribution is one of those things, or distribution, which is when you take money out of your business. Okay, you take your money from the business. That's a distribution or draw. All right, so these are the things that impact your basis. All right, so net income and loss. Let's say you make money in your business. The basis in your business goes up, right? If you make money. If you lose money, it goes down. Now, if you contribute to your business and capital, your basis goes up. If you take money out in the distribution, your basis goes down. Pretty simple. All right, so net income basis goes up. That's how much investment how much you have in your business, the basis that you have in it, it will go up. Now, if you take a loss, well, the amount you have in your business goes down. If you take your money personally and invest it into your business, that basis in your business goes up. And then if you take money out of it in terms of a draw or distribution, that value, that basis in your business, what you have in your business, the amount value goes down. Okay. So that's the impacting events for basis. Those are the impacting events for basis. Now, why is basis so important? Is because when you go out here and operate your business and your business loses money, this is where it really impacts. Okay. When your business loses money, then you can't take any more loss than what you have in that business in any particular year. Let's talk about it. Okay. All right, so let's talk about this. All right, so if your business takes $100,000 loss for whatever reason, your business takes $100,000 loss, but you've only put $50,000 into your business, and you only have that in your business that particular year in terms of owner basis. All right, so you have $50,000 in it, but your business loses $100,000. Well, your deduction is limited to $50,000 for that year. The other $50,000 out of that 100 would have to carry forward until you have enough basis later on to take another loss. Okay, that's how that would impact you. All right, so a lot of people don't really go around here knowing like how this works. You might think you're able to deduct a whole lot because you took a major loss in your business, but then you haven't really put a whole lot in your business, and you're wondering why is it that I'm not really taking this loss like I thought I was going to take this year? Because you didn't have enough in your business for that loss to be realized. You would have to carry that forward to another year until you have enough in that business to take that loss. Okay. So this is a basis is something that we want to look at in terms of a cumulative account. It always stays there year after year after year. It has a cumulative effect, which means it builds over time or it takes away over time. So if you have an increase in basis one year, well, that stays with the business in the following year. And if you have another increase, well, it builds on that value for the following year and then into the next year. But then when you take a loss, it takes away from that amount. Okay. When you put money into it, it increases that amount over time. So it's a perpetual thing. It continues to move forward as long as that business is in existence. And we measure this thing, if you're in like I say, an S Corp, we measure it by what we call a 7203. It's a basis form for the IRS to report your basis in your company. Take a look. Now, if you have a partnership, they'll report the worksheet for accumulated basis adjustments. All right. So now we want to take a look at those things to see how that's going to work in real life. Now, before we do that, I want to get into loans. We're talking about loans today. I had to lay that groundwork so you can understand, all right, how the loans impact taxes. Because sometimes, just like anything, you can be upside down on things. You can have a negative equity inside of your business because of your financing activities, like loans, taking out loans and everything. Okay. Let's say your business has assets in amount of $100,000, but you have a loan amount of $150,000. So your assets are less than the amount of loans that you have on the books, which means that you have an upside down position in your equity. Okay. So now this impacts your basis. Like equity is really translated into basis as well. Like if you have, like it can impact you in a certain way, like it's a correlate thing. It actually impacts your basis. It's not the same thing, but it impacts your basis. Okay. Now, if you have a negative equity in your business from the start, now let's say you're somebody who goes in their business and you're not really making a whole lot of money in your business. And when I say this, let's get specific. Let's talk about like scenarios. You start your business, you have this scenario where you have 100,000 in assets and you have loans $150,000. And now your business has a profit of like maybe 45,000. And you decide to take out more than that 45,000 for your cost of living. A couple of things are going to go on with that, right? You're taking out more so than you have in the company in terms of basis, okay? Because now, let's say that your basis is just that amount, like around 50,000, and you take out more than that 50,000 throughout the year. You've taken out excess of your basis in the company, which means not only will you not be able to take the loss if your company has a loss in the future for that year, you also have to pay money on capital gains, most likely, because you've taken money in excess of what it was in the company. So that's going to be considered income to you. Say that again, like you've taken out money in excess of what you have in the company, and that will be considered income to you in terms of capital gains. Otherwise, it doesn't count as income. You take money out of your business as a distribution or draw, as a sole proprietor, as an S corp, or as a partnership, then that money is yours anyway. It's not considered to be additional income. The profit of the business is what impacts the income. If you're profitable, you have income. If you're not profitable, then you don't. But if you take money out in excess of what you have in that business, then you're going to be looking at something like capital gains. This is what happens when people take loans in their business because they think they have more money in it than they do, because they have the financing to it. But they take that money out of their business and they don't have a whole lot of equity in there or basis really in that business, instead to be distinct basis in that business, then they'll suffer an impact for capital gains. And this is something that you really don't want to not know inside of the actions that you take, because you could end up with a surprise tax bill at the end of it, is what I want to say. Okay. So let's talk more about this. Basis. So this is an example of it, like a basis reporting on your tax return. Okay. So there's a beginning value that's accumulated from prior years. That could either be 0 or more. Sometimes I see it, they have negative from the start. They have negative, so they got to catch up, right? But let's say you have what this example has 200 in the original basis from prior years of activity. This is how much they have in their business. Now they make money, 5,000. So now at the end of the year, they have 5,200 in basis, but then they take out 10,000. What? But you only have 5,200. But you're taking 10,000 in the distribution. So now the difference, that $4,800, will need to be reported on your individual tax return as capital gains. It's like, what? Shut up. I do. Are you serious? Yeah, I'm serious, man. You gotta go and pay taxes on this money, even though you would not normally expect to, right? So how does that happen? Usually that happens if you have more, like if you have like loans that provide that opportunity for you to take more out of your business than what it has in it. Like it could be misleading to look at the amount that you have in your business and you're taking money out. Now, I'm taking money out more so than what you have in it, causing you to have this liability in taxes, extra liability in taxes, beyond the $5,000 profit, if that makes sense. Okay. So now what do we want to do? We want to understand, like, okay, well, if I'm taking a loan for my business, up front, you want to see the impact of that loan, and you want to manage your funds appropriately so you're not dealing with these types of surprises come tax time. Okay. You want to make sure you understand what it is, how you're going to allocate these funds through your business to ensure that you're not going to overpay in taxes by way of taking money out of your business more so than what you have in it. You never want to have a negative upside down position in anything investment wise. This is one of the pitfalls of operating a company, is because we don't look at these things. We don't know if we're in the beginning, especially if we're not profitable, we're taking a loss, and now we need money and funds to live. Well, how do you manage that for yourself? And I'm really speaking to the small business owner right now, the person who's just getting started in the first few years of their business, and they haven't really generated enough accumulation in terms of their basis in their company. And now they're looking at these options. Well, what am I going to do to generate an income? Loans want to be taken out in order to produce you more in your business. Loans want to be taken out in order to produce you more. Leverage in a business, it wants to be such that you are returning more so than what you borrowed. You're using that money to make more money. We don't want to use that money to pay our bills, personally. But you're like, yeah, Chester, but you don't understand. I'm dealing with my rent. I'm dealing with groceries. I'm dealing with my kids. I'm dealing with all these things, and I need the money. Yeah, figure something else out, man. Because this is not making the situation any better. You're making your situation worse, and it's really short-term thinking if you're thinking that way. You want to make sure when you take loans, it serves a purpose to improve the value of the company. And you want to understand what that value is from the start. Okay. Now, there are other ways where you're not necessarily, taking out money from your business in terms of a distribution. I don't recommend this all the time, but you could borrow money from your business. You create a note, and that does not necessarily have to be income to you in capital gains. You can make a loan to yourself from your business and pay that loan back with interest. Now your business is making money off of that asset that business has for you as a borrower. Okay, that's a workaround for this. But you want to understand, number one, what is the consequences of me not understanding, like, this cumulative account that we call in our business called basis, and me just going out here and doing things without considering how my actions are impacting that. You could end up losing big time. You could end up having a surprise day, thinking that you're going to have a tax deduction, and all of a sudden you have an extra tax bill It could go that that way. Think, man, my business lost money, so I got this deduction. But what? I have an extra capital gains bill. What happened? Well, you took this loan, sir. It looks like, and then you took out more money than what you had in the company. And then we're treating this as capital gains. What? But I took a loss. I can't take a loss. No, you didn't have enough in it this year to take that loss. You got to take it another year when you do have enough in the company to realize that deduction. And you're like, man, what? I got to owe this money? But this is the impact that you want to consider. All right, everything like we do financially in our business, there's a consequence to it, positive or negative. Okay, so you want to understand those things for yourself so that you can go out here operate in a way where you're always going to win. All right. With that being said, we're going to complete on this call, guys. Great being with you this morning, and I'll see you next week. Take care, guys.